That's made my hair stand on end because it made me realise that I was talking about this several years ago and I've forgotten about it.
The other big space I think we're missing is corporate assets, right? We have seen a complete reversal over the last 20 years. It used to be that 80% of corporate valuations were linked to tangible assets and only 20% to intangible. And now we've seen that reverse. And think about these intangible assets that we can now make tradable. Algorithms, proprietary algorithms, data exhaust, systems that are being built inside organizations and processes that they have developed, right? I think that you're going to see a new type of capital raising emerge from corporations where they're going to take control of their own assets and tokenize and directly distribute and raise capital from these assets. So I think that we're starting with kind of the cultural wave, but I think following that will be a big corporate wave where the whole issuance model and the whole equity and debt issuance model that has really ruled throughout our lifetimes will change, and you'll start to see a very different, more direct to consumer type of capital raising from corporations and institutions.
That's made my hair stand on end because it made me realise that I was talking about this several years ago and I've forgotten about it. Which my view was, well, Exxon is a big, messy, ugly business. And it's made up of hundreds of businesses. And because it gets tarred with the brush of being an oil company, they all trade at a discount to what would be NAV.
Yep.
And if you were to tokenize Exxon down to its component parts, but still operate it, let's say, in a DAO, you're going to unlock, as you say, enormous intangible value.
And even if you start before the DAO, right, if you have 7 parts of Exxon that you can be investing into, and they see that all of the investments are going to these 4 and no money is flowing to those 3, that would accelerate Exxon's decision-making to start winding down those units because it's no longer their total revenue isn't being bundled. They're actually unbundling where people are willing to invest, and they're getting that direct from the consumer signaling that they can't find today because their revenues are all bundled up with the different parts of their business, some of which people may really want to invest in, and some of which people may not want to invest in at all. So I think it's going to also give them a much better signaling mechanism for business strategy.
I love the idea of crowdsourced capital allocation within businesses.
Mm-hmm.
Because they get to decide. Now, not always to the crowd right, and you don't have to tokenize all parts of your business, but it makes total sense as a way of efficient capital allocation.
And I think it will allow, some of the backlash against ESG that's been building, because it's such a broad stroke, it will allow these companies that are being excluded from capital allocations to now open up and get capital allocations into those parts of the business that people want them to develop the most. So I also think it kind of takes away some of the ESG extremism that we've seen in the marketplace.
The other part, before I move on from corporates, is tangibles. I've been talking about this, tangibles versus intangibles. I think the two biggest intangibles on some corporate balance sheets are brand and culture again. So the one I always highlight this with is Disney. Disney's a $200 billion company. What is the cultural and brand value of Disney? It's probably $1 trillion, maybe $2 trillion. Probably got the largest cultural brand value of any company on earth. And Web3 unlocks that because you can get the people who benefit from the brand and the culture to participate in the economy, creating network effects around it and valuation of the intangibles.
I mean, what's so interesting is when you start thinking in this framework, Raoul, isn't the Disney parks, weren't they almost like the precursor to being able to have Disney NFTs or Disney tokens? Because they were a way to bring that community of Disney enthusiasts together and give them an experience but it was a physical experience. And now we can start to see that same type of affiliation and ability to leverage your brand evolve as a digital experience as well.
Absolutely right. The other thing that we've seen within Web3, which has been very new and not surprising, but surprising how fast, is how brands can come from nothing to, I don't know, Yuga Labs at peak was probably $14 billion, $15 billion in 18 months.
Yeah.
I think that was the fastest accumulation of brand value or corporate value I think I've ever seen. And yet there's no products.
Yeah. Well, to me, this was the perfect, this is the perfect bull market phenomenon. And what's interesting is that, when you look at the history of the crypto markets, we really have just finished what could arguably really be described as the fourth bull market in crypto. And what has happened is each time that bull market has become increasingly amplified, and the companies that get, or the protocols that get attention during it have become increasingly amplified. The money coming in has become increasingly amplified. And this one has wiped out, I think, and this downturn from that fourth bull market has wiped out a lot of the more questionable players. And as this shakeout finishes and we start to see the real potential of the decentralized portion, because don't forget, most of these blowups that we're seeing have been in the centralized players, not in the decentralized players. I like to point out to people that, we had this whole FTX situation, but in that same week, the decentralized exchanges absorbed a 4x increase in volumes with no issues whatsoever. Right. So I think that as we see this next bull market take place sometime in the next 18 to 24 months, that should start to build again. This, I think, is going to be the really transformational bull market that really starts to change society and behavior.
Yeah, I was just looking through, I build Metcalfe's law models for network adoption, and I was just going through some of the models today, and one of the things that's been very interesting about this bull market versus 2018, I mean, I've been in this space since 2013, but 2018, we saw about 60, 70% of the entire participants leave. So the active addresses went down. If you look at ETH, which is the best proximate for Web3, the active addresses have not gone down at all.
No.
So they're staying. So the adoption builds on itself.
That's
so the
right.
next phase, which that's what I want to ask you is, what do you think the next phase is? My personal opinion is it's consumerization of Web3. So that's what we've been talking about: music, NFTs, brands, and even where blockchain gets abstracted away and you don't really know, which is Reddit talking about digital, whatever it is. What do you think the next phase is here?
I think that's exactly right. I think you're already starting to see some interesting, I'd say, green shoots, right? Ether has turned disinflationary since the merge, right? Which is a signal to me that, this is now a marketplace that is becoming very attuned to supply and demand. And I think that what you will see happen is that this consumerization wave is also going to be occurring almost entirely on public blockchains. And I think a lot of what fed this last bull market were these centralized players, and the public blockchains were beneficiaries of it, but they weren't the drivers of it. And I think this next wave is when all of the apps on these decentralized public blockchains really start to take market share away from the TradFi players and take market share away from the established platform companies and start to see that money moving into decentralized peer-to-peer models. And that's going to force traditional companies to change their behavior and start to adopt the Web3 paradigms. And that's when I think you're going to get this massive bull wave, because you're really changing the foundational platforms on which society is built and operates.
Yeah, I totally agree. And, painful though these bear markets are, if you look from low to low, they're always rising. Just look at the Bitcoin chart, even when you take the low, and I took it from like 2011 low all the way to now, it still rises on average at 150 40% a year.
I'll take that.
Hey visionaries, thank you for tuning in. For more free crypto content like this, head over to realvision.com/crypto. You'll get early access to the most brilliant minds in the space to cut through the noise, get in-depth analysis, and get you ahead of the curve with unbiased insights.